What if I told you that two people can buy the exact same insurance policy, same company, same coverage, same everything, and one of them will pay hundreds of dollars more every single year, not because they made a mistake, not because they got unlucky, but because of one number, a number most people check maybe once in their life, a number that insurance companies use to decide how much you are worth to them. And here is the part that makes it worse. The person paying more, the one who cannot afford to pay more, will also have their claims denied at a higher rate, will receive worse customer service, will be dropped by their insurer faster when things go wrong. Think about that for a moment. The people who need insurance protection the most are systematically receiving the least of it. This is not a conspiracy, this is not illegal in most places, this is just how the insurance industry was designed to work. And it works this way at every income level, differently, quietly, in ways that most people never notice, because nobody ever explained the rules of the game they are playing. Until today. Because once you understand how insurance companies actually treat people at different income levels, every insurance decision you make from this point forward will be different. And that difference will save you money, protect you better, and make sure you never find out the hard way that the coverage you were paying for was never really what you thought it was. Let me show you exactly what I mean. Meet three people. Same city, same general needs, very different experiences with insurance. First there is Dani. She is 24 years old, works part-time, earns just above minimum wage, rents a small apartment and drives an older car. Insurance for Dani is not a choice she makes carefully. It is a bill she pays reluctantly, the minimum required by law, chosen almost entirely by price. Then there is Marcus. He is 34 years old, works a stable office job, earns a middle-class salary, owns a modest home, and has a family he is responsible for. Marcus has more insurance than Dani, but has never really sat down to understand what he actually has. He bought what his agent suggested and has not revisited it since. And then there is Claire. She is 48 years old, runs a successful business, earns significantly above average, owns multiple properties, and has a financial advisor who reviews her insurance coverage annually. Same product. Three completely different realities. Let us start at the bottom and work our way up. Because the story of how insurance treats low-income people is one of the most important financial stories almost nobody talks about. When you earn very little, insurance companies see you through a specific lens. And that lens is not neutral. Here's something that surprises most people. In many places, insurance companies are legally allowed to use your credit score as a factor in determining your premium. Not just your driving record for car insurance, not just your health history for health insurance, your credit score. The logic the industry uses is that people with lower credit scores file more claims on average. Whether or not you agree with that logic, the result is clear. The people who are already financially struggling pay more for the same insurance coverage than people who are financially stable. This creates a deeply ironic situation. The people who can least afford high insurance premiums are charged the highest ones. And because their premiums are high, many of them choose the minimum coverage to keep costs down. Which means when something actually goes wrong, they are the least protected. This is not a coincidence. It is a predictable outcome of how the pricing model works. There is a second layer that affects low-income policyholders even more directly. It is called claim treatment. Multiple studies have shown that insurance claims from lower-income zip codes and lower-income policyholders are denied at higher rates than identical claims from higher income policyholders. The policies may be the same, the damage or loss may be identical, but the outcomes are systematically different. Part of this is resources. Wealthy claimants can hire public adjusters, attorneys, and advocates to fight denied claims. They have time, knowledge, and financial cushion to push back. Low-income claimants often cannot. When a claim is denied and paying for a fight means not eating, the denial wins. Insurance companies know this. And the third layer, cancellation rates. Insurance companies drop policyholders they consider unprofitable. Low-income customers who file claims, miss payments, or live in high-risk areas are dropped at significantly higher rates than wealthy customers, who then have to find new coverage, often at higher rates, because they now have a gap in their insurance history. The cycle is self-reinforcing. Low income, higher premiums, minimum coverage, denied claims, dropped policy, higher premiums again. Now let us talk about the middle. Middle-income people like Marcus have more coverage and more options, but they face a different and in some ways more insidious problem. It is called the advice problem. When you buy insurance as a middle-income person, you are almost always buying through an agent or broker. And here's what most people do not understand about how insurance agents are compensated. They earn commission, a percentage of the premium you pay, which means an agent who recommends a higher premium policy earns more money than an agent who recommends a lower premium policy that might serve you equally well. This is not corruption, it is just incentive structure. But the result is that the advice you receive about insurance is never entirely neutral. The person telling you what you need has a financial interest in you buying more. Middle-income people are also particularly vulnerable to a problem called coverage illusion. They have insurance, they believe they are protected, but they have never actually read their policy, never understood what is excluded, never stress-tested the coverage against what would actually happen if something went wrong. The most common version of this is underinsurance, the home insurance that would not actually cover the full cost of rebuilding after a fire. The health insurance with deductibles so high that a serious illness would still be financially devastating. The life insurance that would cover 6 months of expenses rather than the years of income replacement it was supposed to provide. Middle-income people pay for protection they do not fully have, and they do not find out until the moment they need it most. There is also the upselling problem, extended warranties, add-on riders, supplemental policies. Insurance companies are extraordinarily good at selling middle-income people additional products that generate profit for the insurer without proportional benefit for the policyholder. A rule that wealthy people know and middle-income people often do not. Insurance is for catastrophic losses, not for every possible inconvenience. Insuring against every small thing is almost always a bad financial deal. The premiums consistently exceed the value of the claims over time. That is literally how insurance companies make money. Now let us talk about what happens at the top. Wealthy people have a completely different relationship with insurance, and understanding that relationship is one of the most useful financial insights available regardless of your current income level. First, wealthy people treat insurance as a negotiation, not a take-it-or-leave-it transaction. They compare multiple providers. They use independent brokers who work for them rather than the insurer. They understand that almost everything in a policy is negotiable if you know what to ask for. Second, wealthy people use insurance selectively. They self-insure for small and medium losses because they have the financial cushion to absorb them. They carry high deductibles to lower their premiums significantly. And they use the insurance they do have for what it was actually designed for, protecting against losses so large they would genuinely threaten financial stability. This is called strategic insurance. And it saves wealthy people enormous amounts of money over a lifetime, while actually keeping them better protected against the risks that matter. Third, wealthy people have advocates, financial advisors who review coverage annually, attorneys who know how to handle insurers when claims are denied, networks of professionals who know how to navigate the system. The result is that wealthy people pay less per dollar of real coverage, have their claims paid at higher rates, and are rarely dropped by their insurers. Here is the insight that ties all of this together. Insurance companies are not in the protection business. They are in the risk assessment and profit business. Protection is the product they sell. Profit is the product they keep. This is not cynicism. It is just the honest description of how the business model works. And once you understand it, you can interact with the system much more intelligently, regardless of your income level. The goal is not to distrust insurance. Insurance is genuinely important and genuinely valuable when used correctly. The goal is to use it the way wealthy people use it. Strategically, selectively, with full understanding of what you are actually buying. Here is your practical takeaway. First, understand your credit score and work on improving it before your next insurance renewal. In states and countries where credit scoring is used for insurance pricing, improving your score can meaningfully reduce your premiums. This is one of the most direct financial benefits of building good credit. Second, at your next policy renewal, get at least 3 quotes from different providers. The variance between what different companies charge for identical coverage is often 30 to 50%. Most people never find out because they renew automatically. Do not renew automatically. Shop every single year. Third, raise your deductibles. If you have a financial cushion of even a few $1,000s, raise your deductibles and use that cushion as your first line of defense for smaller losses. The premium savings over time almost always exceed the cost of the losses you absorb. Fourth, actually read your policy, specifically the exclusion section. Not all of it, just the exclusions. Understanding what your insurance does not cover is more important than understanding what it does, because what it does not cover is where people get devastated. Fifth, if you ever have a claim denied, appeal it, always. Insurance companies deny claims knowing that a significant percentage of policyholders will simply accept the denial. The appeal process exists specifically because regulators require it. Use it. Or hire someone who knows how to use it on your behalf. Let me bring our 3 characters back. Dani started checking her credit score monthly and found an error that was artificially lowering it. She got it corrected. Her car insurance premium dropped by 18% at the next renewal. Marcus finally read his home insurance policy and discovered his coverage limit was $60,000 below the actual rebuild cost of his home. He was underinsured and had no idea. He adjusted it. Claire realized she was paying for 3 supplemental insurance products her financial advisor identified as redundant. She canceled them and redirected the premiums into her investment account. Same system, different outcomes, because of what each of them understood about how the system actually works. Here is the thought I want to leave you with. Insurance is one of the most important financial products in your life, and it is also one of the most systematically misunderstood. Most people buy it because they have to, pay it because they must, and never think about it again until something goes wrong. The people who get the best outcomes from insurance are the ones who treat it like any other financial decision, with research, with comparison, with regular review, and with the clear understanding that the company on the other side of that policy is optimizing for their interests, not yours. Your job is to optimize for yours. If this video changed how you think about your insurance, hit the like button. It genuinely helps more people find this content who need it. And our next video goes deep on the one financial product most people own, but almost nobody understands, and how understanding it finally could save you thousands every single